Imagine this. The market crashes. You rush to your brokerage account to pull out your money. You click withdraw, and nothing happens. Error message, processing delays, account frozen. Your cash is trapped while the market burns. This isn't a conspiracy theory. This has happened before, and it's about to happen again. In the next crash, millions of investors will discover a terrifying truth. Their money was never really theirs to take. And by the time you're watching this in February 2026, the warning signs are already flashing red. Wall Street has a dirty secret they don't want you to know. It's called a liquidity crisis, and it's the silent killer of portfolios. Here's how it works. When everyone tries to exit at the same time, the doors get locked. You think you own an asset you can sell anytime, but that's only true when there's a buyer. In a market crash, everyone is selling and no one is buying. Suddenly, your so-called liquid assets become useless. Let's look at what happened in March 2020 when COVID hit, markets plunged. We saw trading halts and circuit breakers triggered over and over. Major brokerages like Robinhood and Interactive Brokers experienced massive outages. People were locked out of their accounts for hours, sometimes even days, unable to sell as their portfolios bled out. This was just a preview of what a real crisis looks like. But it gets much worse. Go back to 2008. After Lehman Brothers collapsed, even supposedly safe money market funds started breaking the buck. The reserve primary fund couldn't honor redemptions. People thought they had cash, but all they had were IOUs from a company that couldn't pay. Here's the mechanism you need to understand. You don't actually hold your stocks. Your broker does. And your broker doesn't really hold them either. The DTCC does. It's all just digital entries and layers of promises. And when the system gets stressed, those promises can break. Take real estate investment trusts or REITs. You're supposed to be able to sell your shares any day the market is open. But in March 2020, many REITs suspended redemptions completely. Investors were trapped for months watching their value plummet. Mutual funds have something called redemption gates buried in the fine print. If too many people try to cash out at once, the fund can legally freeze withdrawals, forcing you to stay invested. And what about those high-yield savings accounts? Many limit how much or how often you can withdraw. When SVB collapsed, even insured depositors couldn't access their money for days. We saw it again in 2022 with crypto exchanges like FTX and Celsius. Billions of dollars were locked up overnight. Withdrawals were paused, and then the platforms collapsed. Your crypto wasn't really yours. It was in their custody, and when they failed, it was gone. The key takeaway is this: true liquidity is rare. In a systemic crisis, the rules change. Understand where your assets are actually held and the risks involved. Don't get caught when the music stops. Thanks for watching, and be sure to subscribe for more insights the financial world doesn't want you to hear. Bond funds are particularly dangerous. Bonds are supposed to be safe, right? But bond funds are different from bonds. A bond matures and pays you back. A bond fund never matures. It's constantly trading bonds. In a panic, bond funds can collapse in value because they have to sell bonds at fire sale prices to meet redemptions. We saw this with UK gilt funds in 2022. Pension funds nearly imploded. Redemptions were halted. Pension funds themselves. Think your pension is safe? Many pension funds are dramatically underfunded. When markets crash and stay down, these funds can't meet their obligations. And we've seen this in multiple states and countries. Benefits get cut, payments get delayed. The promise that seemed guaranteed becomes negotiable. Here's what's different about the next crash. The entire system is more leveraged than ever. Global debt is at record highs. Derivatives markets are massive and interconnected. When the next crisis hits, it won't be isolated, it will cascade. Central banks already use their ammunition. Interest rates in 2020 went to zero. They can't go much lower. Quantitative easing has limits. The Federal Reserve's balance sheet is already enormous. The tools that stopped previous crashes are either exhausted or will cause different problems if used again. Settlement times are another hidden risk. When you sell a stock, settlement takes 2 business days. T plus 2. In those 2 days, anything can happen. The counterparty could fail. The clearinghouse could have problems. In a fast-moving crash, 2 days might as well be 2 years. Bank bail-ins are now legal in many countries. This is different from bailouts. In a bail-in, the bank takes depositor money to recapitalize itself. It happened in Cyprus in 2013. Depositors woke up to find their accounts had been converted to bank equity. They didn't get cash. They got shares in a failing bank. The legal framework for this now exists in the US, EU, and other major economies. Exchange-traded funds have a dirty secret. ETFs are supposed to trade at their net asset value. But in stressed markets, they can trade at massive discounts or premiums. In 2020, some bond ETFs traded 10% or more below their NAV. If you sold in a panic, you got 90 cents on the dollar for assets theoretically worth $1. And that's if you could sell at all. Retirement accounts have restrictions you might forget about. 401ks, IRAs, these have rules. Early withdrawal penalties, required holding periods. Some employer plans limit when you can move money. In a crash, you might be forced to watch your account value evaporate with no ability to act. Insurance companies and annuities, these are supposed to be rock solid. But insurance companies invest the premiums. They're heavily exposed to bonds and real estate. When these markets crash, insurance companies become stressed. We've seen insurance companies fail. We've seen them suspend withdrawals from annuities. The guarantee is only as good as the company's solvency. Here's the psychological component. Most people have never experienced a real crash. If you started investing after 2009, you've only seen one direction, up with minor corrections. You think you'll be rational when markets fall. You won't. When your account drops 30% in a week, panic takes over. And that's when you'll discover these restrictions. The regulatory response will make it worse. When crashes happen, regulators often impose restrictions to maintain stability. Trading halts, position limits, withdrawal restrictions. These are framed as protective measures, but they trap you in a burning building. So what's an investor supposed to do? First, understand counterparty risk. Who actually holds your assets? Can you take physical delivery? For most assets, you can't. That's a risk you need to acknowledge. Diversification isn't just about asset classes. It's about custody. Don't have everything in one brokerage. Don't have all your cash in one bank. Spread the risk across multiple institutions. Know the rules before you need them. Read the fine print. What are the withdrawal limits? What are the redemption terms? What can the fund or institution legally do in a crisis? Have true liquidity outside the system. Physical cash, not just in a bank account. Actual currency you can hold. Gold or silver you physically possess, not paper gold or ETFs. These are insurance policies. Understand the difference between paper assets and real assets. A stock certificate is paper. The company is real. In extreme scenarios, the paper can become worthless while the underlying value persists. This is why some investors prefer direct ownership of businesses or real estate over financial instruments. The next crash isn't a question of if, it's when. And every indicator in February 2026 suggests we're closer than most people think. Market valuations are stretched, geopolitical tensions are high, economic imbalances are massive. The setup is there. When it comes, most people will be shocked by what they can't do. They'll try to withdraw and find restrictions. They'll try to sell and find no buyers. They'll try to move money and find gates and limits. The illusion of liquidity will evaporate. Your wealth isn't just about what you own. It's about what you can access when you need it. $1 million you can't touch is worth less than 10,000 you can use. In the next crash, this distinction will be painfully clear. The system is designed to work when everyone plays by the normal rules. But crashes aren't normal. They're when the rules change. They're when you discover the promises were conditional. They're when your money becomes their decision. Don't wait until the crisis to learn these lessons. The time to prepare is now. The time to understand the risks is before they materialize. The time to ensure you have real access to your wealth is when everything seems fine. Because when the next crash comes and you can't withdraw, you'll wish you'd watched this video earlier. You'll wish you'd taken action. You'll wish you had understood that liquidity is an illusion that disappears exactly when you need it most. The game is rigged, but only if you don't know the rules. Now you know. What you do with this information is up to you. Stay alert, stay liquid, and stay in control of your financial future.